What are forward contracts versus futures for hedging? Imagine you're a farmer worried about the price of wheat dropping before harvest, or a bakery concerned about rising flour costs. How can you protect yourself from these price swings? That's where hedging comes into play. Today, we're going to look at two common tools used for hedging in commodity markets: forward contracts and futures contracts. Both help manage risk but work quite differently, and understanding these differences can make a big difference in your investment strategy. A forward contract is a private agreement between two parties to buy or sell a specific amount of a commodity at a set price on a future date. These contracts are customized, meaning you can specify exactly how much you want, when you want it, and under what terms. For example, a farmer might agree to sell 1,000 bushels of wheat at a fixed price for delivery in 3 months. Because these are negotiated directly, they are not traded on any exchange. This makes forward contracts flexible but also riskier because if one party defaults, the other might lose money. Also, since they are not standardized, they tend to be less liquid, meaning it's harder to sell or exit the contract before the delivery date. Futures contracts, on the other hand, are standardized agreements traded on regulated exchanges. They specify a fixed quantity of a commodity, like 100 barrels of oil or 10,000 bushels of corn, with set delivery months. These contracts are marked to market daily, which means gains and losses are settled every day based on the current market price. This process reduces credit risk because the exchange's clearinghouse acts as the middleman, guaranteeing the contract's performance. Futures requiring traders to deposit margin money, which is a percentage of the total contract value, to cover potential losses. Because they are traded on exchanges, futures are highly liquid, allowing traders to buy or sell contracts easily before the delivery date. When it comes to hedging, forward contracts are great if you need a very specific deal. For example, a company might want to lock in a price for a certain amount of a commodity to match their exact needs. But because they carry the risk of default and are less liquid, they are better suited for parties who trust each other or have a long-term relationship. Futures are more practical for most investors because they are easier to buy and sell, have less counterparty risk, and offer the flexibility to close out positions before the contract expires. This makes futures a popular choice for managing price risks in commodities. In summary, forward contracts are private, customizable agreements that fit specific needs but come with higher risk and less liquidity. Futures contracts are standardized, exchange-traded, and marked to market daily, making them safer and easier to trade. Both tools are valuable for hedging, but your choice depends on whether you prioritize customization or liquidity and risk management.